Have you ever played XSP? I've used it to test like some like condor strategies and stuff that I didn't want to throw a lot of money at and butterfly things, but other than that, no, it's garbage. And the spreads are really bad on it. I mean, if you have to use it, it's fine. If you just simply don't have the capital for SPX, I understand, but if you do, there's almost no reason to use XSP over SPX. What do you see most realistically at Jamie earnings report that would be the most bullish case scenario? Since we never know, they don't give guidance. um, Probably like slightly positive EPS and not as shitty revenues as expected, or revenues at least in line with how shitty they're expected to be. I think that would be the best case. Worst case would be, EPS and revenue miss, which is probably the most likely outcome. It's not the most bullish one, but for hedging, calls only hedge directional, where selling the opposite of the hedge position provides directional. Yeah, well, because when you sell a spread, like if you turn a directional position into a credit spread, you're saying that the stock can move the opposite way or it can trade flat. But if you buy the opposite, right? So if you have a put and you buy a call, you're hedging only the upside. If the price stagnates, both of your positions get burned up, right? Now, if you really, you can double down on the price trading flat if you want by, you know, like say you have a put and price drops, but not to enough to put your position in the money, right? So your put's here and price drops to resistance, which is above your long short. You can sell a credit spread on this, and then you can also and like if you don't think the price is going to bounce, you can also sell a credit spread here, and then you can wait while the price stagnates. If the price starts to move up, you can close the short call and leave the long call open. And similarly, if the price moves down, you can close the short put and leave the long put open. And part of planning your trade is defining the levels at which you're going to do those actions instead of reacting in a panic, right? And being like, "Oh shit, the price is going up. I need to do something." That's not a good position to be in. You should already have a plan for that, right? The problem with XSP, it's too easy to let things ride because it's so cheap rather than selling a 45-cent contract for 60 versus 450 for 6. Yeah. It's I mean, yeah, it's lower capital allocation, so it's more forgiving. There's also an aspect to that like I think the pickle jar is starting to learn broadly, but a lot of people still haven't fully grasped. A lot of people like to enter their position all at once and then pray. And since a lot of people have smaller accounts, this generally is full port. And what's crazy is, as prices move up, and I'm trying to show people this a little more in Pickles Picks lately, like with Apple over the last couple of weeks, a little bit with Nvidia, right? How I'm like, taking profits and then moving back into a position when I have more confirmation. Entering your position slowly as you confirm the upside or downside over this period, right, allows you to then capture more. Like you can leverage more here after you've confirmed, the levels that you want to see as you approach your price target. Whereas most people seem to be worried about cutting their positions on the way up. When you start to get good at trading and more confident in your positioning, it's beneficial to add to your positions as it moves up. And right now, I feel that most people are averaging, like, when they add to their positions, they're doing it when it's failing. So, like, the position's taking the opposite trend, and they're increasing leverage here where the thesis is wrong. Which is kind of like throwing good money after bad. as opposed to throwing good money after, confirmed profits. Now, not that averaging down is always wrong, and everything in the market is dynamic, and there are some times when averaging down is really good. But generally speaking, broadly, no. If you're adding to your loss, you're leveraging up your incorrect choice. I'm not trying to single anyone out, but I mean, and some people are learning this. I think they're scaling in and out of positions, which is where you want to get. But I feel attacked. I'm taking this personally. All right, well, I tried. I heard you say bullish confidence has declined on SPX, especially now that we're trading under 45.20. 45.20 was the big call wall here. Downside in the money call interest is lower on the 0DT side because profits were taken earlier today. So we could continue to fall from here. I really don't think there's a level that's that important. Maybe 4,500 on SPX, but on futures we do have relevant resistances. And the next one to the downside is at 45.20 or roughly 45.12 on SPX. You aren't singling anyone out because most of us are doing that. People enter their position all at once because PDT, but if you're entering your position, like if you're entering like a 3-day swing over the course of an entire day, then why do you care about PDT? You can keep adding to a position with PDT and then close it all at once and it's still one trade. I'm not saying open and close the position. I'm saying add to your opening position as you confirm that you are correct, not as you confirm that you're wrong. So if I listened carefully, breaking down on 45.12 SPX, I could scale in. Well, if you were short now, like for example, this is generally not a great entry because it's indeterminate which direction it's gonna go. But if you were to bet on bearish continuation, knowing that price action is slightly weaker below, upside potential is slightly weaker below the 45.20 strike. We're trading at 45.17. The break up, like the bounce from our bottom here is not very strong. So what you would do effectively is you would enter a put here, right, with a stop set at the prior high, and then as you confirmed like 45.15, which is the next strike down, you would add, and then at 45.12, which we know is resistance on futures, you could add again, but you would be bringing your stop down in line with the additional positioning, right? And then once a bottom is realized the next time, you would begin to cut these. So you would cut your initial put, then your 15, then your 10, I would imagine, as price action reverses. If price action keeps continuing, you simply keep moving your stops down in this case. Well, up. Entry points are a challenge for most traders. I think position management's way harder than entering. But and so this bounced, right? A little bit up, but not to where your stop is, right? So if this was just a pretend trade, this isn't bouncing up to your stop, right? But you wouldn't add on that bounce. And if it were to bounce up like almost to your stop and then start to turn, you wouldn't add here either. Because so far you've been wrong about the direction, right? Like this tells you picked a bad entry, and the better entry would have been up here. So, and I think a lot of people add on these, like, they'll buy a put like here, right? Then it'll drop, they won't get stopped out on the bounce back, and then they'll add here and here, right, as price is moving back up. And you're not always, when you start doing that, you're compounding your losses. And if this stabilizes, which it very well could, and then breaks up, you're and now you're on 3x leverage. That's why it's much better to like, oh I was wrong, here's my prior stop. This would have gotten stopped out, right? But if it hadn't, right, maybe you set it a little looser, or you bought like a 1 DTE, and you did confirm it, you wouldn't add till you got to like here, right, where you started to be right again. And then you'd probably cut it here. I mean, it's almost a $10 move. Well, a break of 45.12 drastically increases the chances of testing 4,500, right? Think of everything as being probabilistic. I think that's one of the things that, like, more people fail on it than anything else, is they don't understand that, you know, the market is dynamic and also chaotic, right? And price targets, there's far more nuance to them, and the way, like, trading levels on an index works. You know, when I give you guys, like, oh, we're bullish above this strike, the further we move above that strike, the more bullish it gets up to, you know, wherever kind of positionally things are capped at. You don't enter at that strike, right? You'd want to be in, and you'd want to catch the bullish momentum into the higher level, right? And then you would, you know, scale out as the bullish momentum peaks and starts to kind of move back the other way. But like here, you know, we break down through 45.20, and that increases the likelihood of a test at 45.12, and a breakdown of 45.12, because it's a key futures test, increases the likelihood of a test of 4,500. But like say like right now, a test of 4,500 is, and this is arbitrary, but like there's like a 30% chance we see 4,500, and the market maker will define this accurately. I don't want to look at the options chain though. And then, you know, at a breakdown of 45.12, that the percentage chance of seeing that strike goes up. And prudent entries are one step of risk management. Fun way to practice position management is playing 0 DTs in sub 1K cash accounts. Lots of white knuckle moments for nominal gains. Hey, you can turn a 0 DT 1K cash account into 10 grand really, really fast, and then lose it all just as quickly. If you want to see the profit and loss from this account over the last month, I can show you just how often you can turn $1,000 into $10,000 and then blow it all up. I'm just giving you shit. Tesla is not prudent here, I am guessing. Well, it found support, and I think it found support right about at entry risk, right? Close. It's a higher low. I mean, you have the trend, and risk is tight. It's not terrible. You could tighten risk up even more and have risk at like just sub 256, right? And then, you know, if it doesn't bounce, you just get stopped out. You're not committing a lot of money to testing a bounce, although it's moderately risky. This is not a very bullish bounce. But this kind of goes into what, you know, I told you guys before, in that, like, risk management is far more important than being good at identifying entries or understanding the way a stock is going to move, right? If you entered this exact same setup on Tesla 500 times, you know, 200 of them would print, and then if you didn't lose a significant amount of money on the other 300 attempts, over 500 attempts, you would still be profitable. So if, you know, 200 of those attempts, you make 20% on the upside, and the other 300 attempts, you lose, you know, 2% on the downside. After all is said and done, you're up. Every time I hit 2,000, I take out 1,000. So far, it's working. That's one way of managing your risk. But you're taking on having a sub $25,000 account is a huge disadvantage. What's your prediction here, big guy on SPX? Looks bearish. We lost 45.20. That was the call wall. Not that we can't bounce back up to it, but things look like they're going to continue moving down. There's a shitload of short calls at 4,500 because of the JPM collar, and VIX is moving up. Can I borrow 25K? No, but you could earn it. Don't go into an account that big without a plan, man. Let me tell you right now, I've seen enough people blow up enough money over the last 2 years. Don't move into a $25,000 account until you have a very, very good plan for what you're going to do with that money. I've always known that, like, scaling is where most accounts fail, but on a broad sample of people, I never realized quite how bad it is. It's bad. It's really, really bad. To be fair, you have a biased sample. Yes and no. I've been stuck between 25 and 50 for like a year now. Well, identify why you lose money, and then don't do that anymore. Help us earn 25K by trading SPX calls, puts for 1,000% moves. I mean, that's great, right? Like, it's like, in a cash account, if you're just scalping, it's not that hard to turn, some money into more money. The problem is scalping doesn't scale, right? So once you have a decent amount of money in your account, you're stuck choosing between, do I want to make $300 a day, or do I want to make, $1,000 a day? And if you want to make $1,000 a day, scalping starts to become way less attractive because you have a huge amount of slippage. You take on tons of risk in every position. And sometimes you can get perfect scalp entries over and over and over, and they just keep failing. You get 2 days of that, and your account's empty again, right? And so like, most people are probably pretty capable of building a port up through scalping. It's just what you do after that point. You can scalp $100,000 worth of SPX 0 DTs. It's not very smart. I do it sometimes, and I win enough that it's okay for me to gamble that way, but it's gambling, right? I've lost on 0 DTs on SPX. I've lost like 5, 12, 15 grand just on slippage from a stop. And when you don't have a lot of money, you can't afford to do that. That's a lot of money you're losing. The markets aren't actually that crazy right now, but like in 2021, SPX, like, you'd move up like 80 BPS in a day, and then you get like 2 red candles and you're down 50 BPS. And if you entered a scalp on the upside move, your contracts would go from like $18 to 50 cents in like 2 minutes. Can I make $1,000 a day stripping instead of scalping? Yeah. Most people are definitely not capable at scalping to a large scale. Well, that requires like laddering and actually doing math on the value of your options, but and even then, I mean, the most competent like desk traders I know still experience a lot of slippage. Scalping's an okay strategy, but it's not good for, it's just not good for scaling. Even if you are good at it, there's much better ways and lower risk ways to make money. If not scalping, what kind of strategies would you suggest for accounts over 25K? Spreads, swinging spreads, but lots of theta selling, right? Like, reduce capital exposure, try to increase directional, like, well, you want directional exposure, but on reduced capital exposure, because you can get a lot of leverage for very cheap, and you only need to be incrementally correct. And you also don't carry around tons of theta decay all the time. So, like, debit spreads are really good. Debit spreads aren't even bad in a small account. They can just be kind of a bitch if you can't close them. That's the problem. That's the biggest problem with them. One of the biggest problems with this account is me doing like Franken spreads and not being able to close the trade when it's up. Like, having to just hedge the opposite move every time, which reduces profitability significantly. Is this de-risking or a trap to get us over GN? It's some de-risking. Dollar broke back above 103.50 too, and it's moving up. It's up almost 50 BPS today. So dollar up, VIX up, at least with the current yield curves. What's the most amount of 0 DT SPX contracts you should scalp per position without getting slippage? 5 to 10 is really the best. And even then, only at strikes that are liquid. Big resistances like 4,500, you can scale up a little more, like 25 contracts. For 0 DTs beyond that, I probably wouldn't go a lot higher than that. Not at a single strike. If you care about the slippage that much. Sometimes slippage is just a byproduct. Like, it's just something you have to deal with.